Hey everybody, it's Lawrence from Financial Stream. Wait, no. Lawrence from Financial Thing with the Financial Stream. Totally tripped me up tonight. How's everybody doing out there? Welcome to the stream. It's Thursday evening, 7:31 UK time. So glad you're able to join me for, I think, what will be less than an hour tonight. I always say that every week. But make sure you read the disclaimer if you're new to the world of investing or peer-to-peer lending. Please read this disclaimer on the screen. This video is for informational purposes only and is not designed to be financial advice. Of course, everything we talk about is theory, my opinions, my expressions, and your expressions too. If you have questions or comments, put them in the stream. Let me know where you're chatting tonight from in the comment section so I could say hi to everybody. And hopefully the weather is not treating you too poorly. I know the UK weather at this time of year can be absolute poo-poo, but it's just part of what benefit you get from being British, right? We get to live in the crap weather. Not me all the time, but so we're going to chat a little bit about some investing principles tonight, the power of starting early. And I want to show you a couple of things that I've been looking at over the last couple of months. I know I've been promising you a new peer-to-peer lending company that I've been investigating, but I'm not quite ready yet. I know I say that every week. Hopefully next week will be finalized and I'll have done all of my research, but I don't want to start talking about them yet, just because, you know, things have to be researched and we have to do our due diligence more than ever nowadays. So please hit that thumbs up if you can, and that helps me out a lot, and subscribe to the YouTube channel if you're not already subscribed. Hopefully the sound is good tonight. Let me know if you can hear me okay. But yeah, tonight we're going to talk about robo-investing too. Started robo-investing about 3 years ago, and I did it as a way of just some experimentation. I wanted to see what the returns were. People had been emailing me saying, Lawrence, what do you think about robo-investing? And I've always been very skeptical about it because I think that they just don't stack up to index trackers. That's the bottom line. But I wanted to see for myself. I wanted to put some cash in. Put a bit of cash in, and I want to show you the results after 3 years, and I'll let you know how they compare to my usual investing method, which is the index trackers. So we'll go through that tonight. We're going to talk a little bit about the Funding Secure update that was put out, the latest numbers, what's going on with the administration. I'm going to show you my Wealth Simple account, which is my Robo Cash, and also another company that I found in the States that I really like, which I think is going to be the future of investing in the UK. There isn't anything really like this in the UK at the moment, but I think if you keep your eyes out for it, this type of product will come. And I think it's one thing I find it to be great for is for kids and for younger people. So I'm going to talk about that, but let's go ahead and say hi to everybody in the stream tonight, like we always do. Mike Powell is here from Changeable Sutton, my neck of the woods, Southampton. Football team, not bad, right? Not as good as the Cherries, but I don't know much about football. I just think the Cherries are better than Southampton. What can I say? Hi, Peter Vince. Evening all. He says he went out for a walk across the common today, but the weather gods reinforced the stay-at-home message by raining on me. Sun came out again as soon as I got home. Bar humbug. Peter, remind me where the common is, because I don't know. Stephen Green is here from Southporty. Is that Southport or Southporty? Alan in a chilly Basingstoke. Stephen Hale, evening all, as Jack Warner used to say, showing my age when I was a lad, from Nottingham. Nice to see you, Stephen. Always welcome, welcome. Colin Perry, of course, from the Peaks District. David Dawson, hi from Staffordshire. Nice to see you, Double D. David Alderman from the Chiltern Hills. Is it chilly in the Chiltern Hills? Bad joke of the day. Hi, John Day in Nottingham. Keith in Lincoln, my neck of the woods where I was born, in the wonderful town of Grimsby. Paul Bagworth from Kenilworth. Interestingly, you have worth at the end of your name, Paul, and you live in a place that ends in worth. Coincidence? I think not. Margaret Sims from Carpenter's Park. I have no clue where that is, Margaret. Maybe you can enlighten me. It sounds wonderful. Chica Boy, welcome. Nice to see you in Folkestone. And Hillary Hare Duke in Nottingham. We've got a lot of people in Nottingham tonight. Look at that. Nottingham Massive representing strong. Michael Shaw from Battle. Nice to see you. Hola a todos. Annabelle Nieran. ¿Cómo está? ¿Cómo te sientes, Annabelle? And yeah, where is Akichak tonight? Rajesh Dodia. Hi, nice to see you. Rajesh. Sorry if I butchered your name. The eyes are not like they used to be. Hi from Wimbledon. Wimbledon, home of what's the Wombles? Wait, Wimbledon Common. Stephen Hale. Stephen, yeah, how's the share account doing? Any update? Probably doing one myself next week. Stephen, I just put up a new video on the YouTube channel. If you look, you'll see my November 16th update. The portfolio has been doing good, but we've made some changes this week. Got rid of some of the loose weight on it and invested in a couple of new things. Nikhil Ramnarine. Sorry, my eyes are bad tonight. Hello from Sheffield, Nikhil. And Peter in Leatherhead. Tony in Somerset. And near Margaret Sims near Watford, but it sounds better. It does, absolutely. Yes, I would stick to the Carpenter's Park? Definitely. So, yes, let's get right to it. Again, if you have questions about your peer-to-peer lending investments or your concerns, put them right down in the comments. I'll try to give you what information I have this week. And don't forget, December 4th is our next guest. It's going to be Narinda, who's the CEO of Cufflink, will be on, and we have future guests that will be scheduled into the new year. I think I'm probably going to do one guest in December because of the holidays, and then probably two in January if I can rope some poor suckers, interested parties into coming up onto the stream. Don't forget to join the Funding Secure Action Group. Definitely thankful that we have something like that right now with what's going on with these administration situations. I'm going to go ahead and post the link into the comments here. There we go. Hi, ES from Portugal. Nice to see you. Hopefully you got that's the Funding Secure Action Group. And then we have the Lendy Action Group with Mike Powell, one of our very knowledgeable listeners here. If you want to join that, we have the Wellesley Action Group too, if you want to join that. And the Financial Thing Facebook group, where we discuss all things investing in peer-to-peer lending. So you can go ahead and join those. So let's see, what do we have? Loanpad, usual weekly update. Nothing really changed over there since last week. £39.1 million loan book secured. 14.1 million pound loan book secured on 39.1 million pounds. Average loan to value went up 1% this week to 35%. And they continue to still add new lenders. Currently 2,283 lenders, 37 loans, 1 default, 1 extended loan, and 3 overdue loans. Average loan size is £383,000, up just £1,000 from last week. And we now have what I did notice was the interest coverage fund amount that's being serviced has gone up. I believe 2 loans are being serviced now, and last week it was about £19,000 that have been pulled out of the service fund to fund the missing interest. I think it's covering 1 or maybe 2 loans, but £27,000 this week. So we've seen an uptick, starting to get closer to that £40,000 interest coverage fund ceiling that it currently is. So I'm wondering what's going to happen if that £40,000 limit does get reached. Does the fund then begin to increase? But I'm going to reach out to Louis over at Loanpad and find out what their terms are on the interest coverage fund. But Loanpad still remains to be the slow and steady horse in the race. We have the Tetley tonight, by the way. less than 1 day exit time. So if you haven't signed up, go to the Financial Thing website. They have a really good cashback offer that continues to be offered. You can score yourself some cash back if you feel like Loanpad is something that you want to try. I do personally invest there myself, and I like Loanpad. I think they're a good company with a good product. Some of the members of the stream are currently invested through Loanpad, so I'll go ahead and put that link here if you want to give them a try. And that is not a paid advert. I just tell you that because I tell you about companies I invest in myself. Let's see what else. Nothing really to report at RateSetter. LendingWorks is, we talked last week about their negative interest rate announcement, which really is just, as other people pointed out in the chat comments, that it's really just a way of kind of generating extra fees to put into the, into the Shield fund, which is their coverage fund. And digging through their statistics, their Shield fund balance right now is about 1.292 million, with about 8.9 million of future Shield income that will come into the Shield coverage fund. Now, currently it only stands as 1.89% of the total amount of their loans outstanding. So a relatively small amount, but you also have to remember that money is being paid in daily from borrowers, hopefully. But I do expect that their default rates will still continue to be higher this year because of what's going on with COVID. Right now on their statistics page, showing 2.8% for 2020, which is, I think you're going to really see that continue to rise up. Their highest default rate at the moment is 2017 originated loans back in 2017 at 9.3%. So it really depends, again, what's going to happen with COVID as to how long this lockdown lasts and what the state of the economy is going to be. But LendingWorks is one of those on my watch list. Definitely not in my top 5 at the moment, but nothing really happening over there too. They haven't started lending again, but still receiving payments, which is a good thing. We want to continue to receive payments. Let's go ahead and take a look at Growth Street. They released some new statistics this week. Let me go ahead and throw those up on the screen. Maybe that wasn't this week, but I just want to talk a little bit about what's going on. Hopefully you can see this okay. You can see that the amount of borrowers has really dropped. We started in the mid-80s when this wind-up was announced, and we're all the way down to 35 now, 35 borrowers. You can see some of the expected default rates are starting to climb. Here you've got under construction development loans, 49.06% expected default rate. That is pretty sky high. Under high-tech software programming, 36.5%, and trade down here, 24%. You can look at these statistics yourself if you just Google Growth Street statistics. And out of that whole book of 35 borrowers are expecting now a 15.9% default rate. The good news is that the amount of outstanding credit facility balances has dropped. So as they continue to get borrowers to repay, those amounts are reducing. So what started out as £133,000 average loan facility has now dropped to £98,915. I think at the end of the day, where you're going to see some issues with Growth Street will be at the tail end of the loan book. So we saw a good amount of repayments coming in at the beginning. So those are obviously the borrowers that were able to repay. And now as you come to the tail end, you got rid of about 50 borrowers and cleared them out. Now you're down to the last chunk. I think that's where you'll see the issues probably start to come up, because those are the borrowers that are having a little bit more of a challenge repaying. Again, we don't know, which of these are necessarily in trouble, but I think that would be a normal curve of a loan book repayment, to see it sort of easier at the beginning and then start to get a lot more difficult at the end with those borrowers that can't honestly repay, or are having trouble or are trying to get refinanced. So there you go. Hi, Patty. I believe you're in Ireland, but I'm going to take a guess at that. That's probably a very stereotypical guess. So Annabelle says she's got 15% to get back from Grove Street. So yeah, I mean, just because it says a 15% default rate doesn't necessarily mean that you're going to take a 15% haircut. We don't really know what that's going to be, but we pray for good things to happen. Hi, ES in Portugal. Nice to see you. I don't know any Portuguese, so I'm not going to even attempt to try to say hello to you in Portuguese. Let's go ahead and continue with our wrap up this week. Mintos is considering entering the US market again. I used to be quite a fan of Mintos and had a little bit invested there, not a whole lot, but I never really had any issues getting repaid through them, and the defaults were manageable. What happened to them is in 2019, they tried to apply for regulatory permissions, but the FCA denied them. They said that Mintos did not provide sufficient evidence to demonstrate that they would be adequately capitalized in its business, and they had not shown that its head office would be based in the UK. So I think that they're putting their feet in the water, trying to see if they will enter the UK market, because if you're a UK investor right now in Mintos, you're kind of frozen. You're not able to reinvest anymore, and the money is being repaid. If you're a UK investor who's a new investor who tried to open an account through Mintos, that is not happening right now. They are based in Latvia. They're one of the couple of companies that I think I get a little bit nervous about, those European companies, just because the lack of regulation, it seems like, over there makes me a little bit nervous. And you've seen some of those Estonian companies run into trouble. But Mintos, I think, was one of the ones that I had a little bit more trust in and felt comfortable with. So I wouldn't mind seeing them re-enter the UK market. It might not be a bad thing. Whether or not they will is sort of a question mark. I don't know about that. I'm not convinced that because of COVID they'll even come back into the UK market, but we'll see. Assets capital, as I said last week, you're seeing the discounts drop there. If you remember back when they launched their resale market, you were seeing silly numbers on the discounts. If you were trying to sell something, you were having to discount your loans up to 9, 10, 11% or more. And right now I'm seeing it's constantly drop right down to about 3.2%, which is what I thought would happen once things settled out. The panic sellers would go out early, and then the more level-headed investors would kind of wait and try to get a better amount out of the discounting, which is happening now. So this morning, 3.2%, which bodes better. I think is a lot fairer. Selling out for 10%, I thought was a little bit too much of a haircut. Zopa sent out an update this week. They've got a rather long match time. I noticed it's gone up to 36 days now is the average time to match new money into Zopa loans, which says one of two things. Either they're not writing enough new loans, or there is not enough new capital coming in from lenders to place into loans. I again believe that Zopa is focusing on its banking business and probably is going to cease retail peer-to-peer lending. And if you start to see those average match times continue to rise, what that means is if you deposit your money, it's going to take 36 days on average to get invested into Zopa Core or Zopa Plus. I think as a retail investor, you'd probably be less excited about investing through Zopa. So if the retail lenders start to drop down, then Zopa has a pretty good excuse to say, well, maybe we'll step out of peer-to-peer lending on the retail side. I don't know if that's true or not, but that's just my guess. So over the last week, on the update, the last 4 weeks, they have matched loans to give a projected return of 3.4% in Zopa Core and 4.3% in Zopa Plus. That's pretty good. It's definitely up from what they were projecting a little bit. I think their projected rates were in the 3% range, so you're getting a little bit of a bump there. I don't remember if last week I talked about Octopus Choice or not. I think I might have forgotten to do it, but if I did, then forgive me. But Octopus Choice sent out an update, and they said 31 million pounds in loan capital, which is 13% of their investors' capital, has been returned to investors. If you don't know about Octopus Choice, they're in a holding pattern right now. They're not allowing any new investments, and they're pausing reinvestment. So sort of left in limbo about what Octopus Choice is doing with their loan book. It's a shame because I really like Octopus Choice and what they were doing, but they're obviously being very overly cautious, which goes along with the way the company, I think, was set up to be more of a cautious investment product. So they went ahead and they removed the Octopus management fee, which gave you a bump in earnings up to a projected 5.5% from 4% if you were already an investor. And let's see, the overall rate of return on the loan book last month, so that would have been the month of October, I believe, was 4.65%. They said about 40% of the choice borrowers took a payment holiday and are now paying interest again. Payment holidays ended at the end of October. Reopening trading, they said it's clear demand for withdrawal still exceeds demand for investment. So there you go. This means trading would not provide the liquidity required for the platform to function, and for this reason we have no plan to reopen trading. So that could be the end of Octopus Choice. Don't know. If they have more loan supply than they do have demand for investors, then obviously that would put an end to their business model. Not necessarily their business, because they got some pretty deep pocket backing by the Octopus company, which is a lot bigger than Octopus Choice. Let's see, Funding Circle share price, what was it? 89p today. Seems not doing really well. Just kind of bit. Funding Circle send out an update saying that loan extensions were being offered for businesses that have missed loan payments if they have agreed to a payment plan with us and have shown that they can and have made repayments since their payment plan ended. So they will get a extension for, I think if they are on a 3-month extension payment, if they were on a 3-month payment holiday, they would receive a 3-month extension. And it says if they subsequently miss any repayments, they will once again fall into arrears. Exited out of Funding Circle a long time ago, really didn't have much of an interest in investing through them. I would imagine their loan book is certainly experiencing some strains, and if you're a investor through Funding Circle that's trying to exit, I know you've been experiencing some very, very long exit times. But they are apparently doing what they can do to get a hold on this COVID situation through SMEs. They said other measures we have introduced since March enhanced our risk monitoring to quickly identify and adjust to changes in our loan book and the wider environment, rolled out COVID-specific payment plans to allow businesses to reduce or have a temporary break from monthly payments, strengthened our collections and recovery capabilities by expanding the team, improving productivity tools, and automating workflows. And they've started the Corona Business Interruption Loan Scheme, the CBILS lending, and the Bounce Back loan scheme. So they are trying to make adjustments as is necessary. What else? Funding Secure sent out their progress report. The fees that are racking up are quite hefty, as you see through an administration. And what's scary is that their administration is expected to be extended until October the 22nd, 2023. So we're going to have almost another 3 years of this administration. So the administrators are certainly going to be quite handsomely paid off from this Funding Secure debacle. But so far they've had total gross realizations on their loan book of £23.4 million. That means they've managed to recover gross. That's not including all the fees. 23 million. And they've also closed bad loans that they consider these are absolutely no hope of recovery, and complete total losses of £606,000 of complete dead losses. They still have, out of 400 plus loans total, 119 loans in default, which represents a capital total of £56.6 million in Funding Secure's loan book that is still to be recovered. One of the interesting things that made me laugh when I was reading this report was two of the directors, Mr. Richard and Mr. Nigel, were both overdrawn on their directors' loan accounts. It didn't really state how much, or at least I didn't spot it because I didn't read everything word for word. But Mr. Nigel has offered a full settlement and is going to pay monthly payments, while Mr. Richard is trying to negotiate his overdrawn director's loan account. So wonder what happened to those the money that was in those loan accounts. I mean, maybe it was used to fund them personally when they were going through some financial issues. I don't know. This is just speculation. Not saying that they've done anything wrong, but I found that to be interesting. The administrators were able to sell Funding Secure's company's physical assets for a total of £500. So yes, I thought that was pretty interesting. I think that deserves another applause, or an applause. Yeah, let's give them applause for that. £500 recovery on company physical assets. I guess maybe that's a chair or a desk. So within the Funding Secure administration, of course, like Landy, we have this 5% administration fee waterfall that was in the terms and conditions. So basically what that means is that on a recovery, that Funding Secure receives its 5% fee before investors are paid, which I think is terribly wrong, disgusting, despicable. But it's being challenged, and there's a court hearing for that on January 19th, 2021. I have to say, I don't think it's looking very good on that, because it's in the terms and conditions, and I think legally it's been looked at, and legally speaking, maybe they're going to give the green light to that 5% fee and say, hey, it was in the terms and conditions. This is what you signed up for as an investor. So tough cheese on that one. There is a case to say, well, people didn't know it was in there. Well, unfortunately, if you don't read the terms and conditions, and I didn't, I'm going to be quite honest with you, I don't go through those long terms and conditions. Back then when I started investing years and years ago, I didn't read those things. I just, it's like the Apple App Store, right? When they change their terms and conditions and you just hit agree, more my fault than anything, but it certainly made me a lot more wary of companies now that have strange things in their terms and conditions, because if they do go into administration and you click to accept those terms and conditions, then I think in a court of law, it's going to be probably difficult to overturn that, but we'll see what happens. There is a court hearing about that 5%, and that could turn out to be quite a substantial amount of money. If you think about the total gross realizations of 23.4 million, their 5% number on that could be quite substantial. No, we'll see what happens. Fees so far, the administration is up to 360,000 plus VAT and fees. And again, we're not even really halfway through this administration. Plus another 25 grand, which is called a statutory formality fee. There's been 125,000 in legal fees with the administration, but loan recovery fees are really huge, 2.3 million pounds. Just going to see those fees continue and continue and continue as long as this administration drags out. It's a tough one because as a investor, I'm looking at this administration extension of 22nd of October 2023 and thinking, well, bad for investors because the administrators can keep charging more and more and more fees for the next 3 years. Problem is with the types of loans that they're trying to recover, these real estate and property loans that are a mess and other ones, they need the time to recover and sell them. I don't know if they need 3 years, but I guess if they're under a time crunch, then, what then happens? Let's say the administration was due to end March of next year of 2021. They might just start fire selling things to make sure the administration was wrapped up by the deadline date. So I do understand the need for an extension. It's just a bit of a kick in the balls for investors because those administration fees are going to continue to go higher and higher, and it's going to come out of the pockets of the investors at the end of the day, or the pool of money that is being recovered, so which again affects the investors. So blah blah blah. What else? I wanted to show you, there was an interesting graphic on the website of peer-to-peer banking, which I'm not sure is still up or not, and this may be a little bit outdated. Let me see if they still have. Talk amongst yourself for a second, because I'm going to pull up the website, see if it still exists. It does still exist. So yeah, if you go to P2P-banking, there was an interesting article up there about which, let me grab this for you because I want to show this to you. It's pretty cool. It shows you which peer-to-peer companies are actually profitable. And this is the problem with peer-to-peer lending companies at the moment. When I ask guests about profitability, I'm always asking about that for a reason. Let's see if I can go ahead and zoom this in. Might not be able to, but you can see the graphic here. Hopefully you can see it. But it really shows you who is making money. Unfortunately, it doesn't have 2020 yet because we're still going through that, but you can see nearly all of these peer-to-peer lenders are in the red. We do have a couple of companies on the P&L profit loss sheets that have turned a profit in 2019. You can see, I'll run through these real quick, which ones are profitable. We got Able Rate up here, which is these are in the millions, so not much of a profit, 0.05 million pounds in the profit, just a little bit in the green, so yeah, they're getting there. Bondora is profitable, 2.28 million. Crowd Estate, again, that's not a UK one, 0.46 million. Then Finby, Folk to Folk, is a UK one, 200,000 in the profit in 2019. There is Lendy on here, which is not the UK Lendy. There's actually another peer-to-peer lending company with an extra N. Lendy, Lenny, which is 0.00, which means they don't have any financial data for them, or maybe they just broke even. Peerberry, 0.28. By the way, if my name was Lendy and I was not based in the UK, I'd be damn sure changing my name as quickly as possible. Being connected to Lendy, I don't understand why somebody would call their business Lendy. So yeah, Peerberry, 0.28 million in the green. RateSetter US had a good year, 17.47 million. That's RateSetter Australia. I can't remember if I just said US. RateSetter Australia, almost 17.5 million pounds in the profit. RoboCash, another big profitable company, 15.86 million. Swapper, never heard of them, 0.4 million in the profit. And ViaVest, 0.39 million in the green. Rest of those companies, red. Let's see who had the biggest losses. 2019, Capital Rise, 1.51 million loss. Archover, 1.51 million loss. And let's go back to 2018. Let's see who was the biggest. That award would go to Zopa at minus 17.86 million. So you know, not all the peer-to-peer lending companies are actually listed on this, but if you want to see this list, you can look at it. I'll go ahead and put it in the chat for you. It's pretty interesting. It's nice to see. You can look at it right there. It's good to see who's profitable and who's not. I think it's an important part of running a business, right? Even though some companies are in growth, in the growth mode. So I'm going to go through your comments, and then if you have questions, put them in. And then we're going to talk about robo-investing. For anybody that doesn't know, basically you invest money into a finance company that takes your money and automatically robo-invests it through a bunch of different funds and takes all the guesswork out of investing, supposedly. So I'm going to show you how my account's done over the last 3 years. And yes, go through this. So I'll read your comments. See if we missed anybody tonight. Hi, Aki chat from Accrington. Nice to see you. Good evening. Arthur Ackerson from cold Belfast. Yeah, no going out to the pub, huh? Are you in lockdown in Northern Ireland? I don't know. I would imagine you would be, right? Hi, Wayne, Bernard, and Kent. Nice to see you. Welcome to the stream, Wayne. Definitely. Norman P. is here from cold Sussex. Put a sweater on. It's usually good. Hate to tell you how warm it is here in Orlando. It's about 27 degrees today. A little bit windy and overcast, but it's warm. Chica Boy said, question, why are there not many questions? That's a good question. I don't know. Maybe people don't have anything they need to know tonight. Mike Powell said the issue, and he's talking about the funding secure waterfall through the administration, the 5%. The issue is not that it's in there, but that it's unclear that it ranks ahead of the distribution priorities rather than part of it. Okay, so maybe it'll be re-ranked. Maybe it should come after lenders are paid, which would mean they wouldn't get... Well, no, I guess they would if there's money to be paid out. That's what I would like to see happen. At the very worst case scenario is the 5% gets paid out after investors are paid back. Let's see. Yeah, and it sucks about the lockdown too. I don't know how serious people are really taking the lockdown this time. It seems like the lockdown in the UK is pretty fluid, but I guess you could get fined. John Day says, here's a question. Anyone have a suggestion for a low-risk peer-to-peer lending site paying 3 to 4% with similar risk-to-reward ratios to, say, Loanpad and LendingWorks? Yeah, first of all, John, I don't think LendingWorks is on the same risk level as Loanpad, just to put that out there. I think I would say LendingWorks is more in the medium risk category at the moment, whereas Loanpad I would consider lower. There really isn't anything out there that's even similar to Loanpad. They're very unique at the moment. There used to be LandBay. They're no longer accepting peer-to-peer lending, retail investing, and it used to be Octopus Choice. I consider those to be the real three lower tier category risk peer-to-peer companies. So 2 of them are gone. So really just leaves Loanpad. I don't know. Yeah, I would say probably, as Alan commented, LendInvest might be the next next one, but I do see some things within LendInvest that are make them a little bit higher risk. I mean, they got some pretty big loan balances out there. I think the last time I looked, £12 million loan, £9 million loan. And when you're doing big chunks like that, it does raise your risk up. However, LendInvest is very well capitalized. They're part of a much bigger group of companies. So I wouldn't be opposed to putting them in the ring. The only other thing, again, they're not really they're not peer-to-peer lending. So you're not lending money directly to borrowers under contractual agreements with borrowers. You're lending technically the money through LendInvest themselves. So if something happens to LendInvest, that could get a little bit tricky. But yeah, I mean, you're really thinking about, to a case of liquidity. What peer-to-peer lending companies have liquidity right now where you could actually exit if you needed to? You've got assets, obviously, assets capital that gives you this option to get out of the QAA with a discount if demand exists, which I believe it does. So you could consider them, but risk-wise, I don't think assets is in the same risk category as Loanpad. You could also even make a case for something like Property Partners shares. Again, I don't know if the liquidity is there. I think if you wanted to sell your shares at a discount, that you could make a case for the liquidity being there. But Property Partners is in a bit of a strange position at the moment because of what's going on with COVID. They've seen their occupancy rates of their rental pieces of property drop and have some issues, especially with the student accommodations. So I think every one of these companies has some glaring difficulties that they're facing right now. Cufflink has a secondary market, but the way it works is difficult, and I don't know how liquid it is, because the problem with them is, if you say I'm an investor, has £1,000 loan piece that I want to sell, somebody has to buy that whole chunk. So I can't have 10 people buying £100 each of that loan. I have to find somebody who's going to buy the whole £1,000 or £5,000 or whatever I put in. So I don't really love that secondary market. So again, I think Loanpad is about what you're going to find at the moment and considered to be the lower risk area. Yeah, I'd probably honestly be looking at some other companies, but I don't know. It's a tough one trying to get in that lower interest range. I might be even thinking about premium bonds at that point, because difference between 1% and 3%, it's not a whole lot. Premium bonds are liquid. You're not getting much in savings accounts nowadays. Or you could just punt it and put it all in Bitcoin. I mean, we've seen what's going on with Bitcoin right now. Highly liquid. I mean, you can always sell Bitcoin. And I've talked about this probably for the last year, that I think Bitcoin has a very long-term potential. We've seen a huge run-up. I mean, I don't know what the price is right now, but it was 18,000. I think it was a little bit over 18,000 today. I'm just going to check the price. But if you haven't jumped on Bitcoin, yeah, $17,980. We've seen a run up from 11,000. So almost a $7,000 uptick in a month, which is crazy. Yeah, that's crazy. So 53%. High risk because it's volatile. That's the only problem with Bitcoin. You're going to continue to see that volatility, but I think a lot of people are starting to really wake up to the potential of blockchain and how that can work within the banking systems, also other forms of business, and Bitcoin being the Colgate of the altcoins. Highly liquid. You could sell it like a share. Very easy very easy to use now with companies like Coinbase making this stuff very accessible. So there could be a case for Bitcoin if you want to take a more higher risk approach. Chris Chapman says, any comment on Money Thing? No, I don't have any updates on Money Thing. It's very quiet over there. I assume there is not much, at least I've heard of, in the way of news. Kind of like Collateral, there's just no news. You know, they're trying to sort out the administration. They're trying to sell the properties. And I think you'll see more chunks of information come out in one go than bits and pieces. And I think that's the same for Money Thing. Yeah, Akichak says Bitcoin has shot up over the last 6 months. I see. You should have taken your advice. Hey, it wasn't advice. It was just my opinion. Who knows? Bitcoin could have gone back to $5,000. You know, it was $3,000 months and months ago. And now it's 18. Who knew? I mean, who knew? Peter Vince says, I'm reasonably happy for funding secure and everyone to get 5% of the recovery fee, but not when the company has gone bust and it's ridiculous. I agree. I think it should come after investors get paid. I noticed that a couple of the directors have some pretty big outstanding amounts they're owed of $1 million plus. But hey, you know, investors need to get paid back first. Steven said, Akichap, he missed the boat in the short term on Bitcoin, was willing to wait till the next drop. Yeah, Steven, one thing I will say about this now, if you're trying to time Bitcoin, don't be surprised if you see this thing go up to 40 grand. What's the saying that best time to plant a tree is 20 years ago, the second best time is right now? I've learned market timing is just a useless game, very difficult. I think you'd be better to cost average, and what that means if you got, say, £1,000 you want to invest in Bitcoin, just put in 100 a month for the next 10 months. You know, you'll hit the highs and the lows. So that would be my advice. Because you'll never know. I mean, think about this. If it's $18,000 today and it's dropping and dropping, it goes down to 15, it drops to 14, where's the point where you jump in? You know, your brain's going to be going, well, it's 14. I bet it's going to go down to 11. So I'm just going to wait. That's what happened, you know, to me during the last market correction in March. I was thinking Dow was at 18,000. I thought the Dow was going to go to 13. So I waited and it never did. It just went back up. Now you're going to see probably a break in the Dow at 30,000 soon. So huge missed opportunity there. In stocks if you didn't get in. Alex says, it's interesting that according to peer-to-peer banking, assets capital were in the red even before COVID. Seems like management is not doing a good job. Fees from their large portfolio don't cover their expenses. Yeah, but those are also sort of, you have to remember too that there's growth happening within some of these companies. So those numbers don't always paint the picture of what's going on. And you've also got assets that's charging this management fee now, so they're going to make some extra cash on that. Margaret says, I'm wondering if I missed the boat with Bitcoin. Personally, I don't think, you know, I think Bitcoin's ceiling is, it's unlimited. I mean, well, not unlimited, but if you Google a video on YouTube that says Bitcoin's $10 million plan, watch that video because it's really, really interesting. There are people out there that believe that the Bitcoin could go to 10 million. Again, I have no idea. I really don't, but I think it's good to have some diversity in your investments. I think Bitcoin is one of those things that could be a really big boom or bust. Hoping it'll be a boom. I mean, if it does go to 100 grand or $1 million, you're going to be glad that you got in. And I think it's a minimum of a 4 to 5 year minimum investment. If you want to sign up and get yourself some free Bitcoin, there's my affiliate link down there. I think they give you 10 pounds on 100 pounds of Bitcoin, so take advantage. But no, Margaret, you haven't missed the boat. I've been buying regularly since it was $15,000, and I bought last week when it topped over 18,000. So Steven says, wait and see. I think you never invest at the top of the market, but is it the top? Who knows? I don't know. My gut says it's not the top, but I don't know. David Alderman says, peer-to-peer finance news had a report of LendingWorks saying the crisis has been good for them and they are ending the year better than they started yet. ... Yes, that's good news if it's true. I hope it's true. Paul says, yeah, can you easily convert Bitcoin back to cash? You absolutely can. It's just like selling a stock on the stock market. Very, very, very easy to liquidate. Happens in a split second. And very, very liquid. Yeah, I have a video on that, on how to use Coinbase if you want to watch that. It shows you how to use Coinbase Pro, which I highly, if you're going to buy Bitcoin, do it through Coinbase Pro and not the regular Coinbase, because the fees are a lot less on the Pro, because it's like a pro trading platform. It's a little bit intimidating at the beginning when you first hop on there, but if you watch my video, it'll show you how to use Coinbase Pro. Very easy to use though, very liquid. Peter Vince says, Cufflink secondary market. Larger loans take longer to sell, but they do go. Often there is nothing up for sale. Okay. Yeah. I could see though, if you're a high net worth investor and you're buying loans in the thousands of pounds in one chunk, that it would be difficult to sell, but maybe I'm wrong about that. I don't buy big chunks of loans, so. John Day said, how to look at Cufflink, but the ISA only allows auto invest and some loans may be second charges. Yes, absolutely. One of the, oh God, look at my hair. I need a haircut. One of the downsides of Cufflink is that's exactly right. ISA only allows auto invest. And I'm not a fan of second charge lending, so I stay away from that. I don't have an ISA with Cufflink. Mike always has good information for me. He says that the assets capital figures are for the group. The company operating the platform made $1.6 million in 2018, then heavily invested in growing the loan book in 2019, so it made an £800,000 loss. There you go. Yeah, so do I think that they're growing? Absolutely. Yes, I do. Mike says, hard to say about their growth as growth is out of sight through the CBILS lending. The retail loan book is obviously reducing. Yeah, so as assets capital puts a lot of its focus into CBILS loans that you, as a retail peer-to-peer investor, cannot invest in, you are going to see things being a little bit out of whack over there with what's going on with the growth. But I think that they will personally continue to grow. Okay, let's talk about robo-investing. So Wealthsimple. This is a company that has been taught, I say the right word, advertised as a company that people really seem to like. And I wanted to look at why this is. Robo-investing, right? So the idea is you put your money in on a regular basis And 1 second, phone's ringing. You put your money on some kind of auto invest. It goes into this robo investment, and the investment is put into a basket of funds. And so I'm going to show you my account. Again, I have a pretty small balance because it's not something I would want to invest a lot of money into because I don't necessarily believe in them. So here's where we are. I think I put in, let's see, 450 pounds. That was my net deposit amount. And that was back in October in 2017. You can see here, this has been the result. Money weighted 16.2% return, simple percent 14.6%, and time weighted. So you can see that the time weighted returns account for your daily performance from initial funding until today, and it ignores your deposit and withdraw activity. Money weighted returns accounts for your performance plus the timing of your deposits and withdrawals from your account, and then your simple percentage is just how much you've made from your starting balance up to today. 14.6% on the simple amount, the simple return on the interest. That's 3 years, so we're talking about a little bit over 5%, a little bit under 5% a year. So this is what you can decide how aggressive you want to be with these asset mixes. I went 80% shares, 20% fixed income. And you can see down here, this is what they invest you in. And this is the problem with robo-investing. So they've got me UK equities, 26.1%, which I would probably completely eliminate if I could. And you can see the performance here at 0.5%. So for anybody that's out there thinking about a UK fund's good or bad, I mean, these results really speak for themselves. This is the iShares UK Equity Index Fund. It follows the FTSE All-Share Index that covers 98% of listed companies in the UK. So 26% of my amount went in there, and it's returned me 0.5%. Okay, let's go on. US equities, obviously something I'm very much more interested in investing. 16.8% of my allocation. This is mid and large cap US companies in Canada. 30.4% return. That's the Amundi Index, MSCI North American Fund. Okay. Now, here we go. Vanguard, my US equity index tracker, which I've been telling you guys for years. This is what I think. Personally, this is where I like my money. Outperforming the UK by a huge amount, and has returned 41.2% since October of 2017. Now, you know that 3 years isn't necessarily a very long period of time to track anything, but that's what we're looking at because that's when I started this. So 41% return. Even the company iShares corporate bond in the UK has done surprisingly well. I'm not a big fan of corporate bonds, but 14.1%, but you only have 8.7% allocation. And then you can kind of go down the list and look at emerging markets. Here is return 13.2%. We've got Asia, excluding Japan equities, 18.7% return, and then Japanese equities, 13.1%. Now, this is one of the problems with these robo-investing companies and it's kind of like if you were picking out a stock portfolio, whereas if you've been looking at mine, I probably have too many shares that I've picked out in there. And right now we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 funds, 80% equity, 20% fixed income, so bonds. And you're getting this performance of about an average of a little bit less than 5% a year. and then you're paying a fee for the trouble of, for the benefit of investing through Wealthsimple. Now, I'm not saying that robo-investment is necessarily bad. If you don't have enough confidence to do it yourself, fair enough. I mean, this is going to get you something of a return. There's been times where this account has been doing really crappy. I mean, I think I logged in 2 or 3 months ago and it was 5% for 3 years return. But it is what it is, right? Now, what I wanted to show you is the numbers compared to, let me pull this up, the numbers compared to an index tracker. So if you were to bang it straight into equities in just one fund, this is what your returns would have been like. So this is a comparison. So even if you put it in a global tracker, you can see right here, this is the Vanguard US Equity Index Fund that I've basically have most of my investments in. It's the blue line here, and that's returned over the last 3 years. Let me see if I have this correct. This count may not be right. Okay, no, this is right. 12.67% per year. So compared to the Wealthsimple, which is about a little bit less than 5%. And then even if you put it in the world tracker and you said, well, I don't really like the US, maybe I want some more world exposure, you're looking at a return over the last 3 years of 9.37%. Now, again, that is straight equities. So that would be maybe not a fair apples to apples comparison. But if you did an 80 to 20%, I think you'd be looking probably 7.5% a year versus the Wealthsimple, a little bit less than 5%. If you wanted to just take very much more risk because maybe you're younger or this money is not as important to you, and you can afford to take the swings or leave it for 10 plus years, then you would have done rather well on these basic index trackers. The fees are very low. You're not investing into 8-10 different funds. You're investing into one. And you can see the numbers speak for themselves. Since inception, these U.S. equity indexes returned 16.86% per year, and the Fidelity World Tracker 13.34%. So, what do I think of these Wealthsimple and these robo-investing things? Not for me personally. I think that investing in index trackers is very, very simple. You can do it with 1 or 2 index trackers and be done and never have to fiddle around with it. You don't have to pay, fees to these robo-investing companies. Because remember, on top of the fee that you're going to pay for the fund, you're going to pay the robo-investing fee too. So you can see here what the fund fees are on each of the funds. So you're still going to pay. So the highest one, and thank God they're actually relatively low fees on the funds itself, but here is the highest one, 0.5%. The Vanguard one, the US equity fund, 0.1%. So very low, but you're also going to pay Wealthsimple's fee. And you don't have to do that if you pick out your own index trackers. You can reduce your fees a little bit and take control over your own investments. Or you could stock pick and try to beat the markets that way. Possible you may win over the long term. Highly unlikely because it's very difficult to do so. So yeah, am I going to give the Wealthsimple a thumbs up? I'm giving it a thumbs up for ease of use. But aside of that, once you get an index tracker fund set up, you can contribute to it monthly. It's very easy. So as far as investing, I'm giving Wealthsimple a total thumbs down because of their returns. They haven't been very good. So that's what we can look at. How are we doing for time? Oh God, I did. I can't believe I went over an hour today. I was looking at my information sheet thinking I just don't have that much to talk about because it's been a quiet week. especially for peer-to-peer information. But yeah, we'll see. Again, hit that thumbs up for me if you can. If you have any other questions, pop them down in the stream chat comments. We're probably going to wrap it up shortly. See if you have any other questions. Margaret Sims has to go. Thank you for joining us, Margaret. Nice to see you. I will be finished by Christmas. Absolutely. Yeah, we did see, by the way, Crowd Property reduced. I'm offering that loan that was originally offered on the Funding Secure platform. There was a lot of controversy over that. I don't really want to get too much into it because there was a lot of information that was put out. But, you know, I personally didn't invest in it myself. I think there's some bad comment that goes along with loans that were on one of those defaulted platforms. But it also seems like the borrower might have come up and had some issues with Funding Secure itself. But, you know, whatever. It just, it was weird. You can't go to the pub. That's true. Stephen. Yep. So anyway, that is going to do it this week. Let me see if I have any other information that... Oh, Pakistan approves their first peer-to-peer company for testing and experimentation. I have to say that nearly every scam call that I get from overseas usually comes from India. And I love Indian people. Got nothing against them, but would I invest in a Pakistani peer-to-peer lending company? Yeah, that would be a tough stretch. But, you know, hopefully it will flourish over there. Hope for the best. Anyway, I'm going to get out of here and go get some more Tetley. Thank you to everybody for joining me tonight. I hope you have a wonderful week. And be safe in the lockdown. Wear your mask. Be courteous to others. I know hopefully this coronavirus thing is going to just dissipate one day. Who knows? It's a pain in the rump. I mean, I don't even... I'm not so quick to wanting to run back to the UK yet, but in the US here, we're having our own difficult problems with coronavirus. But be safe, everybody. I'm glad you could join. Please come back next week and sign up for the Financial Think Facebook group if you haven't already. Let me run my ticker here. There you go. And we'll see you next time. Have a wonderful week, everybody. Thanks for joining me. Take care.